Well, it's a shortened week on Wall Street. Good Friday means the markets are closed, and so we're going to have an extended weekend. Perfect time for us to have April's 2-minute drill. Okay, so the markets in the last month, they continued selling as they were doing through January and February. That was all in anticipation of the Fed making its first rate hike. It was expected to come last month. It did come last month, and once it came, the markets rallied for the next couple of weeks after that. But then we got into about a week ago and the market started getting choppy again. There was a lot of nervousness and anticipation leading up to this week's Consumer Price Index report. Yes, it's the CPI. The numbers were for March, and it's one of the major inflation reports produced each month. The report largely matched the expectations of the street, around 8.5%. But the real question afterwards, was this the peak? Was 8.5% the peak? It's an important question because the market is a leading indicator. It generally is looking towards the future and discounting the present moment. And given that high inflation has been baked in the cake for some time now, the market is looking for signs that narrative might possibly be changing. So let's see if we're peaking and what that means for the rest of the year. One of the main reasons economists believe we may be peaking is because we're about to come up against some harder comparisons. Last April was the first CPI report above 4%. And inflation by its very nature is not an absolute number, but rather a rate of change. For example, even if today's higher prices don't move down at all, inflation will drop simply because the rate of change higher will slow. Reasons to believe this is the peak. Well, the Federal Reserve raising interest rates has caused mortgage rates to spike, which may rein in home prices, a big component of the inflation index. Used car prices, which were a major driver of recent inflation, well, they fell by nearly 4% last month. And energy prices have come in. According to AAA, gas prices are down about 25 cents in the last month. Now here's the key. If inflation is in decline, it could give the Fed more flexibility on how fast to tighten the money supply. That could be a good thing for stocks by possibly keeping interest rates in check. We believe we'll need to see consistent improvement towards price stability before the Fed will consider even lightening up its foot on the brake pedal, even just a little bit. And of course, that optimistic scenario could all be just wishful thinking. We have no idea when or how the war in Ukraine will resolve itself and take some pressure off of those high energy and food prices. We also don't know the consumer's tipping point. When will they significantly slow down their spending? So we must proceed with caution. Now here's why I give you that more optimistic scenario. On Wall Street, you always need to be aware of a shift in narrative. For months, the main narrative has been rising inflation leads to more interest rate hikes, which leads to a recession. Okay, yes, maybe that will happen, but it's still far too soon to know. Companies started reporting their financials for the first quarter this week. We need to pay attention to what executives say regarding their business climate for clues on how they see the near future. We'll offer more color on earnings season in the coming weeks in my newsletter, Mike on the Markets. So stay tuned for that. But in the meantime, enjoy your Easter weekend, everyone.